Hey there, and welcome to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst here at ETF.com. This week, I'm speaking with Kristy Akullian, who's the head of iShares Investment Strategy Americas at BlackRock. Kristy, great to have you on the show.
Thanks so much. Great to be here.
Absolutely. So, Kristy, you recently published your mid-year investment directions. Can you tell us about some of the conclusions that you reached? Let's start maybe with the macroeconomic outlook. What are you forecasting in terms of the Fed?
Yeah, great place to start. I think one of the things that we wrote about was just the biggest change that's happened over the last 6 months, even the last 3 months, if we're really thinking about it, is just U.S. growth has continued to surprise kind of to the upside, and the economy has stayed a lot stronger than most people anticipated coming into this year. So I think removing a lot of that left tail risk in terms of recession and that hard or bumpy landing that a lot of us were predicting, I think that just gives us a lot more confidence about leaning into risk elsewhere. So, if growth has been a bit stronger than we expected, the economy has been more resilient, the labor market has actually stayed stronger too. Those are all good things. But the flip side of them is that it's meant inflation has stayed higher for longer too. We've always been a little bit cautious about this higher for longer interest rate regime, but we're really starting to see, again, that clear line of sight into inflation coming down and normalizing, the economy staying still relatively strong. So we think that we're going to get 2 cuts from the Fed this year. And really importantly, I think the difference from where we are now versus what we thought we were maybe going to be in December is that these are going to be good cuts and not bad cuts. They're going to be cuts because inflation is coming down and the Fed can cut, as opposed to cuts because the economy is really slowing and the Fed has to cut. So I think that's a pretty good setup and explains some of the performance that we've seen year to date too.
That's great. So given that macro outlook, Kristy, and it certainly sounds like you expect a soft landing, what's your advice for fixed income investors? How should they be positioning their portfolios today?
Yeah, so fixed income, it remains a really high conviction area for us. This one's been tricky, right? I think a lot of people expected that interest rates were maybe going to start to come down earlier than they were. And so a lot of people pre-positioned for that by getting into fixed income and starting to extend duration. And I'll say and acknowledge here that we've been talking about extending duration for a while. And we also caveated that with, we think that it's a trade that it's better to be early to rather than late. I do think we were a little bit early in terms of how we were talking about it, but certainly for the $6+ trillion worth of cash that's still sitting on the sidelines, investors are going to start to want to think about extending duration, getting their fixed income portfolios closer to benchmark, if not a little bit longer there, to be able to capture some of the upside potential when the Fed does start to cut. So specifically, I think where you get your duration from matters, and we favor the belly of the curve as being the best trade-off between sort of current yields and future price returns. We see something like IEI really well placed to kind of capitalize on those two dynamics. But because the economy is so strong, I think it also opens up other opportunities for investors to search for yield elsewhere. So in this particular outlook that we published, we did talk a little bit about high yield. So we talked about finding some of the higher quality sides of high yield. And we have some systematic strategies that do so, something like HYDB that we like. Bank is a really incredibly popular fund for us, the BlackRock Income Fund. It's actively managed. And what that allows it to do is let a skilled investor go and find areas of the market that are maybe undervalued, where yields are quite high and maybe spreads aren't quite as tight as they are as we see in traditional kind of corporate credit markets. So I think there's a lot of opportunities. The short answer is we love yield. We don't love credit spreads. So being a little bit, particular about where you get those yields from.
Let's talk about stocks now, Kristy. The S&P 500 has been on an absolute tear. It was up something like 19% year to date at the end of the trading session today. Can this rally continue? I mean, we're only halfway through the year and we're up 19%. And do you think Fed cuts are going to help, or they don't even matter?
Yeah, no, I think this has been a year of, if not the record, one of the highest number of all-time highs set in a year. So, on any given day, there have been so many all-time highs set. So I think that this is such a relevant question. One of the things that we looked at, which does give us some confidence that the equity market can continue to move higher. Do we think that it's going to be symmetrical, where we got 90% in the first half, we're going to get as much in the second half? No, because the economy is slowing a bit. But in terms of being able to still move higher from here, one of the things that we looked at is that, earnings have really powered a very large amount of the returns that we've seen so far. So valuations look about the same now as they did at the start of the year. So it's not just that stocks have gotten more expensive, it's that the companies have gotten more productive and the earnings have really backed that up. So again, we're not quite as concerned about the rally. We're probably not even quite as concerned about concentration as some of the other investors that we speak to, because of that earnings growth coming in really strong. Your question about the Fed is really important because we're not calling for it yet, but I think that what can happen is if the Fed does start cutting interest rates and the economy stays strong, is that we can see more of an equity rotation or a broadening out of the rally that we've seen. So, we're not calling for a catch down, if you will, for the names that have done so well and powered most of the rally so far this year. Maybe a little bit more of a catch up in terms of some of the areas like value, so certain sectors within value. I think those can have a stronger performance in the second half as interest rates start to come down a little bit, because those interest rates being as high as they were, they don't affect all companies the same. And so I think small caps, I think value names have really been held down by some of that. And if we see relief, then yeah, we can continue to see a rotation play out.
I want to bring this back to ETFs now, Kristy. BlackRock, obviously the largest issuer of ETFs. And I think you recently surpassed $4 trillion in assets under management. You actually had a record monthly inflow in June, if I'm not mistaken, $150 billion of net inflows. Can you talk about some of the ETFs that are seeing demand?
Yeah, absolutely. I think it's really interesting to dive beneath the surface a little bit for this. What we have seen both in terms of asset gathering and fund launches is that there is just much more of an acceptance of actively managed ETFs than we've really ever seen in the past. I think 40% of all actively managed, of all ETFs that were issued this year have been actively managed. And in terms of flows, we've seen the same. So, I talked a little bit about rotations in the equity market. It wasn't something that we saw in the first half because there was such a kind of continuous story and investors really did prefer quality. Quality has been the narrative for a while. I think that if the macro conditions start to change, we're going to see more inflection points. And so something like DYNF, which is our dynamic factor rotation ETF that's actively managed, that's been in the spotlight for a lot of investors of just being able to respond quickly to those macro environments changing. So I think that's one example of how investors are really using active management to their benefit in a year where we expect a lot of inflation points and probably a lot of changes and frankly, volatility. Not only around the Fed, but around things like election and just growth, slowing a little bit more broadly.
Absolutely incredible growth there in the active ETF space. And do you think this growth in active is going to continue, Kristy? Because I think you recently published a paper where you expect active ETF AUM, you project is going to hit something like $4 trillion in the future. Can you talk about that?
Yeah, it's a big number. And it certainly would imply a really, aggressive growth rate, but we do think that's justified. I think what we've seen in recent data is, again, this adoption of active. We kind of break down the active into a couple different categories. There's the true alpha seeking. There's maybe the single stock selection or the bond picking. There are things like outcome-based or income-based strategies where investors are, some of the portfolio managers are using things like options to enhance income. So I think there's a lot of different flavors of active. And that all contributes to some of that growth. I saw a stat too, and I think one of the areas of strongest growth for active right now is within fixed income. And I saw a stat recently that said that I think it was 91% of active managers that manage $1 billion or more are beating their ag benchmark this year. So this really rich environment for active management and high dispersion, especially within fixed income markets, it makes a lot of sense why investors are gravitating to it because they are outperforming. So, I think strong growth in fixed income and then really strong growth in some of those options enhanced strategies too are going to drive a lot of that.
Fantastic. Well, we're going to have to leave it there. Kristy, it's been an absolute pleasure. Thanks so much for your time.
Thanks for having me.